Okay, right now there's a massive financial phenomenon sweeping the market. If you're a domestic investor aggressively chasing US tech trends, you need to hear this. Welcome to The Explainer. Today we're digging into a wildly popular investment trend that honestly looks incredibly lucrative on the surface. We're talking about the booming DRAM ETF market. With the staggering momentum behind AI and advanced computing right now, money is flooding into this sector at historic rates. But according to recent, incredibly blunt financial analysis, this exact trade is hiding a massive pitfall. There's a hidden tax trap waiting for domestic Korean investors who are rushing to buy into this specific US-listed vehicle, and it threatens to completely wipe out a massive chunk of their capital. So this brings up a huge contradiction. Why on earth would anyone avoid a booming ETF? I mean, it's human nature to chase a winner, right? When we see a highly profitable, US-listed exchange-traded fund pulling in incredible returns during this massive tech rally, the absolute first instinct is to jump in. Nobody wants to sit on the sidelines while everyone else bags double-digit gains. But the source material we're breaking down today issues a stark, urgent warning against doing exactly that. It forces us to take a step back and ask a really uncomfortable question. If literally everyone seems to be making money on this ETF right now, why is the definitive advice for Korean investors to run the other direction? Section 1. The DRAM ETF hype. To get why there's a warning, we first have to grasp the sheer scale of the excitement. And look, the FOMO makes total sense. This DRAM ETF is absolutely sweeping the US market right now. With the explosive, seemingly endless global demand for AI infrastructure and data centers, the DRAM sector is basically printing money. Because of that undeniable momentum, we're seeing massive popularity among CO hack ants, the Korean retail investors who aggressively put their capital into US stocks. They see these booming tech trends stateside and are relentlessly pouring domestic capital across the ocean to get a piece of the action. The logic feels totally bulletproof. Find a hot US sector, buy the corresponding ETF, and ride the wave up. Section 2. The 22% tax trap. Now, here is where the glossy hype of those high gross returns violently crashes into the harsh mathematical reality of cross-border investing. When you peel back the slick branding of this popular US-listed ETF and actually look at the underlying assets driving the returns, the irony is just wild. The heavyweights inside this fund, Samsung Electronics and SKhainicks, Korean retail investors are actively taking their money, sending it all the way across the Pacific to the New York Stock Exchange to buy a US financial product just to get exposure to domestic Korean tech giants headquartered right in their own backyard. It's literally the financial equivalent of flying 14 hours across the globe just to buy groceries from the corner store down the street from your apartment in Seoul. And that geographic detour, it comes with a devastating penalty, 22%. You need to keep this number front and center in your portfolio strategy, because this is not some tiny management fee or a minor currency exchange friction costs you can just brush off. Think about it. If you hit a massive rally and make 10 grand in pure profit on this trade, over $2,000 of that simply vanishes before it ever hits your bank account. Poof! That is a massive chunk of your hard-earned gains completely evaporating. What we're talking about here is the capital gains tax. Under current tax structures, when a Korean investor buys a US-listed ETF, they are automatically hit with a heavy 22% capital gains tax on their profits when they sell. And here's the brutal reality of this specific trap. The tax authority doesn't care one bit that the underlying assets generating that profit are domestic companies like Samsung and SKhainicks. Investors are just getting totally blinded by the US wrapper. Because the ETF itself is foreign listed, you're treated as if you're trading purely foreign assets, and bam, you get slapped with a full foreign tax penalty. When we weigh this current strategy against reality, the flaw is glaringly obvious. On one side, investing in the US ETF means you voluntarily take on unnecessary currency risk between the won and the dollar, you pay US market fees, and most importantly, you surrender 22% of your upside to taxes. On the flip side, you have the strategy of simply holding domestic tech. You're fundamentally buying the exact same underlying companies, the exact same balance sheets, and the exact same market dominance, but taking an entirely different, way less efficient path to get there. I mean, routing your money through New York to buy Seoul, it's just a wildly inefficient way to allocate your capital. Section 3. A smarter ETF alternative. Fortunately, the source analysis doesn't just leave us with a stark warning. It actually points out a vastly superior structural solution. If you are incredibly bullish on the DRAM sector, you absolutely don't have to abandon your thesis. When you put these two vehicles head-to-head, the picture clears up instantly. The underlying assets? Identical. Both the US-listed option and the domestic alternative hold Samsung and SKhainicks. The exposure is a dead tie. But the friction is where the game is won or lost. The US-listed option guarantees that 22% penalty on your gains. The domestic alternative, however, operates under the domestic tax structure. For Korean stocks, this structure is vastly more favorable and generally shields these specific domestic gains from that brutal hit. Mathematically, the domestic alternative is just the superior choice in every conceivable scenario, hands down. Exact same exposure, zero foreign tax penalty. This data really highlights a fundamental rule of investing that is so easy to forget when the market is euphoric and everyone's flexing their unrealized gains online. Gross returns, those big flashy percentage numbers on a chart, are ultimately an illusion if an inefficient tax strategy wipes out your actual take-home net profits. It's like a bucket with a massive hole in the bottom. It doesn't matter how fast you pour the water in if a quarter of it immediately leaks out onto the floor. It's never about what you make on the screen. It's strictly about what you actually keep in your account. Section 4. The final verdict. After breaking down the hype, uncovering the reality of the underlying assets, and doing the harsh math on those taxes, the financial guidance from our source material is completely unambiguous. The analyst delivers an exact, urgent plea to the audience. Please don't buy it. You know, it is incredibly rare in the financial industry for analysts to issue such a blunt black and white warning. Usually, advice is totally hedged with maybes and possibilities, but not here. This is straight up an intervention. They're acting as a trusted guide, stepping in before domestic investors make a critical, unforced error that will literally cost them nearly a quarter of their potential profits, simply for choosing the wrong structural vehicle. And that leaves us with a final provocative question to chew on. Look deeply at your own portfolio strategy and ask yourself, are you investing for the temporary thrill and hype of gross returns, or are you investing for the mathematical reality of tax-efficient net profits? This whole drama ETF trend proves beyond a shadow of a doubt that sometimes the most popular, highly traded investment is actually a trap in disguise. Taking just a few extra minutes to understand the mechanics beneath the surface can save you a massive amount of capital. Keep questioning the hype, look past the ticker symbol, and make absolutely sure your investment vehicles are working efficiently for you, not against you.